We have seen the Fed give out money to every institution around the world. They hid it from the public in the best interest of the public, apparently. They refused to admit who got the money, though it was later determined and made public. What has happened to that money? Why is there no public documentation a decade later? Who is left to stand up to them? Of course, the answer is nobody, no one, absolutely not even a chance. You came here for the truth, so let me unveil that for you. Today we're going to talk about the Federal Reserve, of course. That's what I want to start with anyway, and we are seeing them removing a crutch in a 2-week from now period, so we're talking about the end of March. And I think it's important to look at what they are doing on every single level. This is what they plan on doing. I'm going to say it off the top. They're probably just going to reinstate that extended to a longer date, but we have to acknowledge what they have set out to do and any changes that they make, any words that they're saying, because that's the forward guidance that moves the markets in general and how they respond. Because you don't want to just look at what they say, but of course you want to look at what they're doing behind the scenes. Some of their activities are public, and with that information, we know. Another thing that I mentioned just recently was towards the end of the year, we're going to start finding out who all of the repo money was going to, the primary dealers and so on. But you only find out 2 years later. So we're going to get that information. Of course, I'm going to bring that to you. In this video today, we will be talking about the Fed and their actions. We're going to look at the economy. I have a lot to discuss. There's so much to cover and not enough time. Let's go. This article here is basically talking about all the different regions that are facing yet another lockdown, all of the conditions that are persisting. And this, of course, has an impact on the economies around the world. Europe is one area that is being just hit really hard with consistent economic pressures. And this has been coming for a long time. We saw as 2011 moved into 2012 and you looked at, this whole euro sovereign debt crisis and what I call the euro viral contagion, because this is a problem that cannot be resolved by adding more debt. And so they sat around the table, these technocrats, and decided, I think we've figured it out. We'll just add some more debt on top. Well, of course, today you're looking at it nearly a decade later. And what have they done? Nothing to actually resolve these issues. The economies there could and should be much stronger, but they have very few areas that are really shining a bright light. And that is unfortunate just to see it all. All of the money, at least initially, if you look at what happened all around the world, March 2020, all of the money started flooding into the US. It was leaving Europe, at least from an investor perspective, because they knew that that wasn't the place to be. It was worrisome. How are they going to grow out of this mess, right? And even today, that's still the case. The economy is very different than the stock market. The economies are so weak, and it's not looking good right now for the foreseeable future. That's the economic aspect that I wanted to begin the video with. And then we have to talk about this. Around a year ago, where of course the economy, the stock market was tanking, the Federal Reserve decided to allow banks to buy treasuries and hold deposits without regulatory restriction. This is important, of course, because at the end of March, you can see right here, the 31st of March, that is going to stop. So this is a restriction that had been eased by the Federal Reserve, and now that comes to an end. How will the Federal Reserve react when we come closer to that date? We'll see at their next meeting, of course, but they're probably going to extend it. And in doing so, they relieve a little bit of additional pressure. I don't know what ultimately, if they were to not extend it, what would be the case initially, but that they are looking for every single activity to be constantly and never ending a series of easier and easier monetary policy on all levels. This article here is also talking about the same issue, but it gets into a few others. Powell had acknowledged that prices will move up, but he pledged that the Fed would not withdraw stimulus until the economy had returned to maximum employment, which is unlikely this year, and inflation was both above the 2% goal and on track to remain there for some time. This is a message that has been put out there to the investment community, to the financial advisors, to everybody. You don't have to worry because there's no chance inflation is going to even get to our goal. And even if it does, we are going to allow it to just run hot and stay there for a while. They are trying to signal right now, no matter what happens, you don't have to worry. They have made it very clear what their intentions are. This is the balance sheet of the Federal Reserve, and you could see every month after month after month, it continues to grow. And what are they buying here? Part of what they're buying are mortgage-backed securities. You know, if you saw this back in 2006, let's say, it would have been a joke for them to be holding the amount of mortgage-backed securities that they have today. It's insane. Just to see it. That was supposed to be an emergency event. Okay, we're going to buy all this toxic debt, toxic garbage, and we'll do it because we need to save everybody. But today, they're buying it all up. They're never going to get rid of this. People need to realize what they have done. And this is a takeover. This is a takeover of the financial system. It's not a rescue. But who stands to benefit from all of these activities? Is it the little guy? Is it the average person? No, not even close. Median real personal incomes by quintile. And I don't need to tell you what's in that legend if you can't see it. I think you got a pretty good idea. The majority of people over these years, over the decades, this is going back from 1967 up until, probably 2018, those numbers, or maybe even 2020, those numbers go up into. And you can see that for the large majority of the groups, let's see, if you take that, it's hard to see in this legend, but most of the people, this is the upper 60 to 80%. Okay, so this one has some level of growth. And surely it's there, some level of growth. They're considering that real personal incomes, but of course that's not actually using real inflation. So it's not that accurate, but you can see anyway, there is some growth there, but everybody below that is hurting. Everybody below that, the middle 40 to 60 and down, they haven't had any growth essentially. And that's coming at a time in which everything continues to get more expensive at an exponential rate. That's what's been happening over these years. And then you've got the top groups, of course, the top 5%, as they put it here, that have really, really benefited over the period. The central banks continuously add more to the balance sheet, and it hurts the people more and more. The vast majority of people, if you were to extend this longer and longer and longer, you would see this obvious sign that the longer they continue this on for, the worse people will be, and you'll see that more in each group. There's no doubt about it. The higher up you go in the food chain, the more they benefit. Real GDP versus federal expenditures. I just want to give you a quick update on this. You could see the real annual GDP growth, and of course what their predictions are may be very different from what actually happens, but regardless, I think it's important to note what we've been seeing here, the huge drawdown in the GDP and then the supposed surge that followed afterwards. I think a lot of this is kind of like what we saw with the introduction of Obamacare. It's as if they show you a statistic, and unless you have the full context, you wouldn't understand. When they introduced Obamacare, the GDP was excellent at that moment. Why? Because more people had to spend money on their healthcare. It surged up. So you have some of the same activities taking place today. Despite retail investors' far greater role in the market since the crash a year ago, it's unclear at this point, with equity values and volumes already so elevated, whether individual investors can be the key driver of the broader market from here. I need to just interject something really quickly. The retail investor wasn't the reason why stocks had gone up, okay? They make their trades, and then you have companies like Citadel, which are seeing that, using their high frequency trading, are able to benefit from it. The retail trader is such a small component, okay? You have to understand that. And I don't like that they don't make that known, and that needs to be understood, okay? Households will represent the largest source of demand for US stocks in 2021, according to Goldman Sachs. Is 350 billion, as they suggest, a lot in this context? It represents less than 1% of the domestic equity market value. And Bank of America notes that in the past 4 months, a net $476 billion has rushed into equity funds. So 350 billion over the next 9 months would be a slowdown. Gets into more there. I just wanted to show you mainly what has happened here, where you have a big rush of cash ending up in equity funds. And we have seen, I showed you in the previous video or two, really where that has gone. So if you haven't seen that video yet, I'll link to it at the end of this one, most likely. So definitely check that out, because I think it's important to see the distribution as an investor, where all the money is going. So I show you the EPFR data in previous videos as well. I show you broken down by sector and so on. Definitely watch out for that. Of course, many of the subscribers have noted this. I've shown you it before. The velocity of the M2 money stock is an extremely important indicator to watch. And, I haven't touched on it in a little while, so I wanted to bring it up. We had this slowing down for a long period of time. This has been since basically the year 2000. It's been going down and down and down. But more recently, I had seen it pick up, and I noted that in a video. But now you could see it started to slow down again. And that is an absolute fact. They're pumping a whole bunch of money out there, but the actual velocity is very slow. We'll see as the economies around the world start to open up and, travel is back on and so on, how much of an impact that has. But I just wanted to give you this right here to show you what's been happening, and we'll see how, when the economy returns to whatever normal, I want to say normal, but the new normal, how much of an impact that has on the velocity. You don't have to worry about inflation, of course, because the core PCE rate that the government wants you to actually pretend is real here is at 1.5%. I'm looking forward to seeing what the next one is for February's numbers. I'm sure it's going to be 1.6%, maybe 1.7% at most. They're going to allow it, but it doesn't even matter. It's so fake. It's so phony. You can go to the alternative shadow stats as an example. At the top here, you're looking at the 1990 based alternative, and at the bottom, the 1980 based alternative. And I don't think some people understand this. They say, oh, that's fake. That's not real. Why would I do this? If they would just spend the time to look at what it's all about. John Williams is using the actual calculations that the US government used to use. He didn't make this up. He's just simply recalculating it the way that they did before. And you could take the two, whether you're looking at the 1980 based calculations, which are running well north of 9% on the inflation today, or the 1990 based, which is, somewhere just over 5%. So it's way different from the official CPI that they are trying to cram down your throat. And it doesn't matter to me what the number is. It's higher than what they tell us. We have to lose our faith in the numbers that they provide. That is so key. I see it in the comments all the time. How can you say the economy is bad when the unemployment rate's at 6.2%? And I just have to shake my head. 13,000 American Airlines workers told to tear up layoff notices after the $1.9 trillion bill was approved. The money is going there to the airline industry. In addition to this, I noted how there are more travelers coming through than we've had in a year. So there's definitely good news, if not just temporarily, but at least right now, some good news coming for the airline industry. And I wanted to make note of that. Uncertainty is holding back investment in Canadian companies, with 2021 capital intentions still 12% below where they were back in early 2020. By comparison, capital expenditures for the S&P 500 companies are forecast to rise by nearly 12%. Business might choose to put their capital where they'll have faster return on investment. And of course, they're concerned about what's happening in Canada. On top of this, and I think more importantly, look how much money Canada has already spent. This is what so many refuse to acknowledge. A lot of the people in the industry are ignoring reality. If you've ever seen some of these people's desks, by the way, it is a joke. How they ever get anything done, how they ever remember anything, I don't know. It's just piles of paper everywhere. That's besides the point. You're looking here at a country that spent so much money that how can they get the growth coming later on when they've already spent the money that's got to come out of the future? It's a problem. You can't tax your way to growth. That's all for this video. If you found it informative, hit that thumbs up button. When you do, you are supporting me. I want to thank you for that. If you want to learn about e-commerce, the AmazonGPS.com is where you need to be. It's free. Check it out. If you want the financial system to be distilled into such an easy to read format, both of these books will give you the information that you've got to know. So check it out at the link in the description. All right, this is the video I'm talking about. You definitely want to watch it if you haven't already. So click on it and I'll see you there.